You're looking at a daily chart of the NASDAQ. You can see it's been trading below its 200 simple moving average since January 18th. So it's been almost a full year below this black line here. See January 18th when it was trading back around what, 14.6. Now it's down to 10,004. Last week it traded up to its 10 EMA. Looks like a possible rejection there and maybe some more time in the penalty box below the 200 here. Let's take a look at the S&P. Yeah, they're just in downtrends, lower lows, lower highs. This one, again, below the all its moving averages. Looks like it got rejected at the 10 EMA on Thursday and had another slightly down day on Friday. We'll see where they go next week. The Dow has been able to survive because it's it's buoyed by the Mercks and the Johnson and Johnsons and the Boeings that are performing well. But this one, again, it's the 50's above the 200, which is great, but it traded below the 50 now, and that could possibly be resistance on another leg down right there. It just closed 0.1% below the 50 simple moving average. It did make a high above previous highs, so higher highs is a good thing. Got above the 34,281, but then quickly, reversed. I want to take a look at some stocks in the news on this shortened week here. The holiday shortened week, light volume. The ticker symbol here, Southwest Airlines, is LOVE, L-U-V. No love for these guys. They ruin people's Christmas, including my friend Webby. A couple of my buddies at the gym, they had to rent cars, so Southwest, the stock just dove on heavy volume. And, there's nothing good about this stock at all. Anyway, another stock in the news was Tesla. This thing just fell out. Now, you think that this 108, 105 area, wherever it traded down to, is the low, but it rallied, back up to its, not even back up to its 10 EMA. I mean, this thing just really fell out like a trap door. That's what stocks do in bear markets. You think they're okay plugging along, and then they just fall out. This one is still trading below its, it's quite a bit below its 10 EMA. So maybe a rejection there, and then a leg lower. If I was long, I wouldn't be too comfortable unless it could trade through these moving averages here. Anyway, another stock dragging the averages down is Apple. This stock just in a downtrend. It traded down to what made a new low. It took out the June 16th low, 129.04. Took it 6 months to do it. And then on Wednesday, I believe, it went down to 125. So it closed Friday at 129, but this thing's not out of the woods. I would look for a short, which I look for shorts is when they get rejected at moving averages. So if this thing traded up to 132 and got rejected, that might be a good place to short. Speaking of which, CrowdStrike has been a beauty. I mean, every time it trades up to its moving averages, it gets the Matumbo treatment, and down she goes. Like Frazier, down she goes, man. Look at this every time. So if CrowdStrike can actually, muster up enough momentum to get back up to its 10 EMA, which it's, less than 1% away from it, maybe it'll be another time to short that stock if you're into such things. I want to take a look at a couple of stocks and ETFs, I should say, that are just, if you had a bad year, it happens. Those things happen, but at least you weren't as bad as this one. This is ARK. The innovation, ARKK, down 67% on the year. I put out the math on how much of it a gain you need to get back from a 50% loss. You need a double, and for 67%, you're going to need to take the majority of the next bull market just to get back to even. The other one that kind of surprised me was the IBD 50. That was down 52%. It just shows you, even with good money managers, the bear market, just took a bite out of those growth stocks. You can see the innovator, the IBD innovator, was down 52%. So it's going to take a two-bagger in the next uptrend just to get back to even. Anyway, I just did that to make you feel better. Let's take a look at some stocks that I like. Semiconductor Group. This thing is the equipment group is the group is coming up here. It's 18 now, and ACLS, you could see the Dolly Parton pattern on this one, the base on base. And if you bought it at 80 here, which I had for our clients and people on our website, and they run to 80 to 88, that's a 10% gain. You have to take that in this market, because what happens, it just gets sold off and comes right back to its buy point. That's pretty typical in this bear market. There you can see the base on base pattern there, the Dolly Partons, and yeah, nice little pullback. I kind of like this one right here. Another one I like is the field service stock, Halliburton, slower mover, but it's formed this cup with handle, and yeah, it's getting supported. It's moving averages. Halliburton's doing nothing wrong. Like I say, it's more of a widow stock. It's a slower mover, but one that moves a little faster is INMD. This one looks a little bit like CROX did. Before CROX came out of its stage 1 base. You could see on the weekly chart the big avalanche here, then the bottom, and then now this pattern of a stage 1 base and some consolidation here. So I'm looking for that thing to trade above 40.29. Yeah, so see if it can break out of this base. But I do like INMD. There's a lot of stocks that I like right now, but they're just not performing that well. I did mention CROX. I wanted to show the weekly here, because it's pretty similar to INMD, big waterfall sell-off. Like most growth stocks, it was overdone, and then it came up and formed this consolidation pattern and it ripped higher. This thing went from 80 to 104 in a hurry, actually 66 to 104, and now it's just kind of forming this little flat base pattern here. But CROX looks good to me. Anyway, I'm just going to keep it short this week, just to have a Happy New Year, and we'll get back at it in 2023, and never give up.